Hello and a very warm welcome to the third quarter FY23 press conference of TCS. Wishing everybody a very happy new year. It's a tradition now, so we have a hybrid press conference. We have journalists joining in Mumbai, and we have all our friends from the media joining online, and several who won't be asking questions are joining across the world. And on our social media platforms. If you want to catch that, please see our LinkedIn, Twitter, as well as YouTube pages. For now, let's introduce the management. We have MD and CEO, Rajesh Gopinathan, COO, NGS, Samir Seksaria, CFO, and Milind Lakkar, the CHRO. As always, we start with the opening address from the CEO. Rajesh, over to you.
Thank you, Kritika, and once again, a very happy new year to all of you. Thank you for joining us. Let me quickly start with our numbers. We have had a very good quarter in a seasonally weak quarter. Our revenues grew by 13.5% on a constant currency basis. Translates into 19.1 in reported revenue terms, crossing 58,000 crores in rupee terms, and importantly, a big milestone for us, crossing $7 billion in quarterly revenue in Q3. Importantly, this strong growth has come with increasing profitability. We have registered 24.5% profitability for Q3, and that translates to 14,284 crores in terms of operating profit. Net profit has also grown sequentially by more than 400 crores, getting to 10,846 crores, and at an EPS of 29.64. Our profit conversion or cash conversion of net profit continues to be very strong. We have converted at more than 104% with cash from operations of 11,154 crores. The board has declared interim dividend of 8 rupees and a special dividend of 67 rupees, bringing the total dividend declared in Q3 to 75 rupees. With that, our total payout to shareholders Y2D will be about 33,000 crores, of which about 28,000 crores will be from what is going to be paid in this quarter. Our performance on both on the revenue side as well as on the profitability side is also reflected in our strong customer portfolio. Our number of customers from whom we make more than 100 million rose by 1 to 59 customers on a year-on-year basis. The growth has been led by our significant investment in talent development through the year. As you know, we had hired significantly in the last year, and that has been the basis of our growth. We've been able to leverage that investment, and our net headcount addition this quarter now is at about 57,000 on a year-on-year basis, bringing our total associate count to slightly under 6,14,000 people. Our attrition, as we had called out earlier, has peaked, and I'm happy to report that on an LTM basis, now we have started ticking down, coming down slightly lower than last quarter at 21.3, and we're quite confident of this trend continuing and more significant reductions in the quarter ahead. Our focus on innovation continues to be very strong. We have been reporting to you the number of patents applied. Now today we have 7,134 patents applied, which is an increase of 738 on a year-on-year basis. Even more importantly, our total patents granted has now grown to 2,694 patents, which is up at 493 patents on a year-on-year basis. I've said this before, but it's very important that our patents granted now is running ahead of 1 patent a day on a calendar day basis even. We are very proud of the tremendous impact that our R&D team is having, both in terms of the dedicated pool of about 7,000 researchers that we have, and even more so in the widespread adoption of the research and innovation culture across the wider TCS population. and as supported by our ongoing investments, not just in R&D, but also in creating the right enabling infrastructure, least of it not being the pace ports that we are continuing to open across the world. Coming to segmental performance, revenue growth once again has been led by strong growth in North America, growing at 15.4% on a year-on-year basis and getting to $3.8 billion in reported revenue. UK is a market where we continue to enjoy strong growth in a very challenging environment, and UK also has grown 15.4% on a year-on-year basis in constant currency terms. Europe, despite challenges, we have been able to maintain a good growth rate with a year-on-year growth of 9.7% in an extremely constrained environment. The segmental performance from a vertical industry perspective has been led by verticals like life sciences and healthcare, which have grown at 14.5% on a year-on-year basis, retail at 18.7%, manufacturing has also had a good quarter, and BFSI has come in at 11.1%, getting close to 2.25 billion in overall revenue terms. So that's the wrap on the numbers for the quarter. In terms of overall demand trends, I think the quarter has been and continues to be about different markets behaving differently. North America continues to remain quite vibrant, and overall the economic stance and customer perspective there continues to be quite supportive, if cautionary. UK is, as I said, a challenging operating environment, but our solutions are finding a lot of resonance with customers, and we are significantly gaining market share in that market and continuing to do very well. Europe is the market where client decision making is getting impacted by the ongoing geopolitical challenges there, and requires close watching in terms of how it progresses through the quarter. Otherwise, we are quite happy with the performance, and thank you all for listening in, and we'll open it up for questions from here. Thanks, Kritika.
Thank you, Rajesh. So we start the questions from the journalists present with us, and then we'll get a couple of questions from the journalists that are joining in online. So we start with Sajid Mangat, BQ Prime. Sajid, 2 questions, please.
Yeah, I'll start with 2 questions. Happy New Year, Rajesh. Can you take us through the demand environment? You spoke briefly about it, but in your commentary you mentioned about short-term uncertainties. When you look at it from an October point of view and now in January, how have you seen that moving from uncertainty point of view? Is it now you think that it's coming to an end and you have much better visibility on that? Secondly, growth rate, bill to book, I think you have 1.1. I think last quarter you mentioned 1.2, if I'm not wrong. Is orders coming in a little slow? Coming in, you got $7.8 billion, but is there a slowdown which is happening in closing the deals which is there? For Samir, on the margins front, 24.5%, do you see much headroom as you go into that? The pressure of wages and talent, has it come down significantly for you and for NG? Can you give a bit more on the BFSI space, how it's looking in the US especially? And HR account, negative 2,000 net account. So what went into that?
All right, Sajid. I think the demand and the pipeline is so overall demand scenario has not changed significantly, but to be fair, it would take at least a couple of months more for us to actually know what the decision making is. We have gone into December with everybody being cautious, but our view is that this caution has different color across markets. So if you look at Europe, there is obviously a real big issue out there, and it would take some time for this caution to dissipate, and we need to be cognizant about that, and we'll see where it goes. But if you look at North America and UK, which together constitute about 2/3 of our revenue, and probably 3/4 of our profit, the environment there is very different, very supportive. North America, while this quarter and probably maybe the start of the year might be a bit cautious, but our own view is that into the year, we should see a fairly positive one because there is no structural challenge there. Of course, this is subject to how the whole inflation scenario plays out. But on our one-on-one conversation with clients, we think that this is a caution that is more in terms of being wary and taking a decision slightly delayed rather than anything comparable to Europe. UK, the environment is challenging, but given the fact that there is no immediate flip there that is expected, customers and industries have moved forward in terms of the decision making and are committing to large scale, sometimes cost transformation, sometimes more structural transformations along the lines of what, for example, the deal that we have announced with the leading telecom provider there. So UK, though the economic environment is bad, the decision making is much more decisive and much progressing well. So we are participating in that. So that's the spectrum of demand that you see. And the pipeline also kind of reflects that. 7.8 billion is right in the middle of our target range of about 7 to 9 billion. So it's not bad in itself. Sequentially, it is down a bit. On a year-on-year basis, it is growing. But if you compare it against our dollar growth rate on a year-on-year basis, it's a tad lower than that. I think that's a good reflection of where the scenario is, that in terms of the overall demand.
On the margins, we started this year at 23.4% after giving a full cycle of increments. And then we have made good incremental progress so that during the last 2 quarters. We are ending Q3 at 24.5, and we are very focused on exiting this year at the same margin which we exited last year at 25%. On the wage front, the supply side challenges abating is definitely helping out, because more so on the elevated expectations of salaries and the backfilling retention expenses. That having come down is definitely helping on the margin side.
Yeah, BFSI has grown well. It's about 11% year on year in this particular quarter. Even by the deal momentum, $2.5 billion of deals is coming from BFSI. Overall, there's nothing to specifically call out, especially, more than what Rajesh had pointed out. The decision making in sometimes, is getting slightly, delayed, but then there is nothing to call out as a worry at this point in time. And going by the interactions that we have with our customers, they're all engaged with us in doing multitude of projects. Some are technology transformation, some are related to regulations like data localization, large-scale payment restructuring, payment re-engineering, those kind of aspects. So, I think there is nothing to call out, whether it is in the North America or UK or Europe. Seasonally speaking, this quarter we had certain furlough impact, in more in Asia Pacific than in other parts of the world, but nothing special to call out. It's more or less the same that we typically face in this particular quarter, right?
Was the furloughs higher than a normalized level every year?
No, I think it's comparable.
Sajid, you are aware that we made a significant investment in hiring fresh talent last year as well as the last 2 quarters of this year. And also significant investment in talent development of these people to make them productive now. And that investment is now paying off. Coupled with all the tightening which was talked about earlier by Samir, all of that together basically resulted in a negative headcount. But that does not indicate anything on the demand side. Demand is high, we're just operating it very efficiently right now.
On the absolute level, are you putting more people back on the operations, because you had a good, on an absolute level, the bench was high
Yes,
for you.
yeah. Bench was high for us, and then we were obviously getting also people in the last couple of quarters. All of that together, we are putting more and more people, making more and more people productive and putting them on project work.
Reema Tendulkar, CNBC TV 18.
Good evening, gentlemen. Squeezing in a lot of questions here, so apologies in advance. Rajesh, first question is on client budgets. Are they closing on time? Is it increasing, decreasing, the reprioritization that we're seeing? Second, on sectors. Last time you had called out PNC, insurance, the discretionary spend in retail. Can you tell us any more sectors where you are seeing some headwinds or caution emerging? And just to take forward the statement that you made, looking ahead and beyond current uncertainties, our long-term growth outlook remains robust. How long do you think this current uncertainty, if we are in a demand down cycle, will it be compressed? How long do you expect that to last? Samir, do you maintain exit margin range of 25% for Q4 FY23 that you had guided earlier? And despite a very strong top-line growth, if you could tell us, why was the margin expansion capped at 50 basis points this time? And your peak margins were 26.85% post-COVID. Do you have the visibility that you can get back to that? Because you are talking about steering your profitability towards your preferred range. NGS, is there a risk of deal wins going below your range of $7 to $9 billion? In the event of a macro uncertainty? And if you could talk about the deal cancellations, are they closing on time? And Milind, has the attrition, attrition has come down after 6 consecutive quarters of an increase, but not significantly. So has the easing of supply side been up to your expectations or a little slower? And if you could guide a little bit more on attrition. Thank you.
All right, we'll try to remember everything and answer it. In terms of vertical industries, I don't think there has been any major change in what we have said. So if you think about it, actually what we had said was that we expect this time that manufacturing will be where the impact will come. So far manufacturing has held out. It has not been as impacted as we had originally thought, let's say 6 months back. So we need to wait and be cautious about it, but it's a good thing and we are participating well. So, so far manufacturing is holding out well. BFSI, as NGS said, is growing well. Within that, insurance is slightly weaker, but there's not much to call out on that. And I don't think there is any specific trends there. Retail, when we look into the market, especially if you look at North America, retail sales into the holiday season have been quite strong. Retail profitability has been impacted because of overall cost increases, and they're not been able to pass on all costs to the customers. So the retail industry will go through various transformation initiatives, I'm sure, and we should be able to participate well in that. But net, actually the holiday volumes, even adjusted for inflation, has come in higher than last year. So the industry is in good shape. We'll have to they have to work through the cost implications. So net, so that's why. So if you think about it from a structural perspective, with the focus on US as a more stable economy, we think that barring the current extreme focus on the economic environment, structurally most industries are in a good shape, and we are well positioned to participate irrespective of where the focus is, cost or on the growth side of it. UK I already answered when I spoke about Sajid, and Europe is very difficult to call. So as of now, we don't have visibility as to what the final decision on the budgets are. That visibility will emerge later in the next few months as actual project releases come. But what I just explained to you is based on client commentary going into the holidays. So the distribution that I told between.
Client budgets getting delayed in terms of closure?
We'll get to know that as we, no, it is a normal cycle that we get to know of it only during the course of these 2 months, because as you see the project releases and what happens, so towards March, we'll be in a much better position to talk about where we see the pipeline.
Any indications on
it's first week of Jan, there's not much of early indications. People are just about come in. So that's the spectrum of,
And how long will the tech down cycle last? The current uncertainty?
The current uncertainty again is market specific. The US should resolve itself very fast because we should know quite soon which way it is heading. Europe, nobody knows, and the UK there is no uncertainty. The medium-term environment is well understood, and companies are moving in that based on that decisively. So different markets have different time frames.
Coming to margins, yes, we are absolutely focused on exiting Q4 at 25%, which is exiting the year at 25%. And there would be puts and takes in terms of how it plays out, how the quarter plays out. But as a management team, we are absolutely focused on that. Coming to Q3 margins, we had a 50 basis points improvement. And as I mentioned, we have been progressing steadily on our target range. In Q3, we had 70 basis points coming in positive from currency. And additionally, we had 30 basis points coming in from execution rigor, mainly on account of better utilization, realization, as well as reduction in fees to external consultants on a net basis. And this was offset by higher project-related third-party costs and increasing cost of return to normalcy. And I think last question was, when do I get back? So our first target, we'll take it a step at a time. We'll get to 25%, and then we'll try towards getting to our comfort band as soon as possible.
See, overall, the deal momentum, the deal pipeline looks really good, and our qualified pipeline has actually gone up. Okay, both in terms of medium to small deals as well as the large deal pipeline. So on that count, I have no concerns, right? Where we are today with respect to the deal momentum, and at this time of the year, every year, where we are comparatively, we are feeling there's a feel-good factor about it. Nothing else to really call out, pretty much. And then, the tech spend per se seems to be intact from my perspective, because you have this cloud-related investments that everybody is doing, right? It's actually a race to the cloud, as somebody told me. In that context, that it's really people are looking at not stopping it, but then looking at cloud 2.0, and then see how we can progress with the Horizon 2, Horizon 3, specifically how we can employ machine learning, AI, etc. on the edge. So those kind of investments, I don't think that they're going to stop and start again. That kind of a thing is not affordable. So from that perspective, I think the deal pipeline, the kind of thing that we are working on, gives us a feel-good factor.
And is there a risk to your $79 million dividend range?
I don't think there is a risk to it because of the pipeline that I see, barring the uncertainties that you see and we see and what Rajesh articulated. Yeah.
I think based on the way LTM is calculated, yes, it has come down by 20 basis points. But if you look at our quarterly annualized attrition reduction, it has come down to nearly 6%. Quarterly annualized attrition reduction it has come down by 6%, and that is as per our expectations.
Thank you. Anisha Jain, ET Now.
Hi, good evening, gentlemen. Rajesh, with respect to FY24, do you expect the momentum and the double-digit growth to continue in the absence of, let's say, the mega deals, etc.? And secondly, on BFSI, while you have flagged out that insurance has been a tad bit sticky, it's been coming off from, let's say, 14% in Q1 to 13% in Q2 and now to 11%. what are the chances it will be single digit in the coming quarter? NGS, as far as the furloughs that you talked about, they were slightly higher than expectation than in the Asia Pacific region. Is there any reason to believe that it will have any kind of execution impact in Q4 as well? Because a lot of markets do have extended holidays in Asia in the Q1 of calendar year as well as the nature of the deals. If you can talk to us about, is it largely vendor consolidation and cost takeout kind of deals that you're seeing in the pipeline, and any mix with respect to large deal, mega deal versus smaller deals? Samir, the question to you on the margins has to be that the levers will ultimately come from the supply side only because pricing has become a challenge. Is that the case? That you are mostly seeing the levers coming in with respect to a wage being now settled and attrition being settled, etc. And Milind, of course, the question to you is, this time it was a blip in the headcount addition per se with a negative figure, or is this something which you have factored in for the rest of the year as well? And if you can give us the headcount target for the entire year in terms of the addition, what does it stand at?
So why don't we answer in reverse? Milind, you start.
Okay. All right. So I'll also answer your questions in reverse. So we have added close to 42,000 trainees, fresh campus hires so far, and I think that number will remain, or maybe we may add a few thousand here and there going forward on that one. With respect to addition, basically, like I said earlier, this is all very well planned from the beginning. We have basically been invested in hiring fresh talent and training them for good 6 to 9 months before making them productive, and that investment is now paying off. So it is not, I will not call it a blip. It is actually a planned way of doing it, and we'll continue to optimize it going forward as well.
So in Q4 also the hiring is going to be a bit muted. That's
I'm not going to.
1,000 for the year?
Few thousand. We may go with a couple of thousand plus, or maybe even go muted as well.
On the levers, basically, your question was that will it be only supply side levers? We'll try to pull all levers as possible.
Have all the levers with respect to pricing? Is it becoming more difficult?
Let me finish. Yes, absolutely. See, pricing is always a lever. How much are we able to put on it? And that's a call which we need to take. Pricing, we are getting it on a case-by-case basis. Yes, with the inflation scenario which the world has seen, probably we would have wanted to push it even further. That has not happened, but that definitely remains a lever.
But just to add there, are you getting the new deals at the price points that you want, or is it becoming a lot more competitive and pricing is becoming a challenge even in new deals?
So it's a combination. We are getting deals. The new price points does get factored in. Cost and optimization deals would be competitively built versus sole source deals and the digital transformation deals. We have an advantage.
I think the question on furloughs, I think there is always certain amount of furloughs in certain markets actually fall in Q4 as well. So it's, I think, expected lines, nothing specific to call out, and we're not seeing any abnormality per se over there, right? Second is in terms of mixture of deals and deal pipeline, vendor consolidation and cost and optimization, that kind of opportunities are there, definitely. And it's a mix of both cost and optimization as well as growth and innovation led deals. And it's the mix of, the percentage of how much of it is in cost and optimization, how much of it is in I think it's along the expected lines and where we want to be, right? We want it to be, and I think it's looking good. There are no concerns per se. There are several large deals in the pipeline, and it's a mixture of it's broad based across markets, across verticals, right? Nothing to specifically. I think it's more or less in the same levels. I don't think in terms of the number. As well as in terms of the overall value, I think it's comparable.
Following up on that one, actually our realization both on a quarter-on-quarter basis as well as on a year-on-year basis is actually improving, and we expect that trend to continue in the near term also, because pricing takes time for it to get factored into on the realization side. Coming to the larger question, as you know, we don't comment about things, so it's a bit of a, we'll need to wait and see how this will play out. This year is in a good shape, and as Q4 unfolds and we have better visibility on what the demand trend looks like, we'll be able to at least give you some directional commentary on it. But we'll go back to what we have all said in the last 6 months, and we maintain that medium term in US and UK, we have very strong confidence. Europe is difficult to call, and US and UK accounts for about 2/3 of our business. So we are quite comfortable. And in Europe, we have a very strong presence on the ground. So we should be able to navigate it, and on relative basis, we should be able to navigate Europe well compared to all other players. So we are confident about our ability to play Europe as it unfolds. What the numbers will be, we'll have to wait and see.
No, just the reason I ask you that, Rajesh, in our last conversation, you did say double-digit growth in FY24 is achievable, not just aspirational. So you do stand by that?
I don't specifically, I shouldn't have said things like that because we don't give numbers. It is, if you say FY23, definitely. It's much closer to that.
One quarter left, sure.
We'll take all the other questions offline, Anisha. Harshita Sawant, CNBC Awaaz.
Good evening, gentlemen. I just want to understand, Rajesh, a couple of quarters back, digital transformation was very large for you guys, and that's what clients wanted, and that's where the deal flow also came in. Now, as recession fears are picking up, especially in the US, and you say you have no certainty on Europe either, how have the client needs changed? Where is the business coming in from? NGS, a lot of banking clients have said that a lot of banks, in fact, in US have indicated to massive layoffs in the coming quarters. And these are the big banks. How does that impact demand for you? Is that an opportunity, or do you think business could slow down? For me, I'm just confused as to what I should be asking Milind, because he's basically given us an outlook as to how muted the hiring could be. But what is your sense of hiring in the coming fiscal? Is it going to be as strong as it was in perhaps FY22-23, or it's going to taper down because supply side challenges aren't as important at this point in time? And for you, sir, you said higher third-party costs still exist. When you don't have as many supply side challenges, why is work being given to these third-party players, and how soon do you see them tapering down?
Actually, can I add to that question? Why are you looking at a workforce reduction if higher third-party costs are still weighing on your profit margin?
So let me take that first and explain. See, our fees to external consultants has gone down, and if you look at it from an absolute perspective also, it is almost flattish. What I meant by project-related third-party cost is what we call out as equipment and software costs. So it is more linked to project-related hardware software costs, not in terms of external consultants.
No, but also, Harshada, a lot of it comes from on-site, and that's more a factor of how travel opens up, and we need to bring in supply into that local market. And that market still continues to be supply constrained, and that supply side is only opening up now. So a lot of that cost base is actually on-site cost base rather than offshore cost base. So during the course of the year, you should see that coming off, right? Because that supply is easing, but it has time. That answers your question also, because these are different regional ones. Continue. Visas will be there, travel will be there, local hiring there will be, but local hiring, we expect on-site local hiring to ease up given what has happened in the last 3 months or so. So we should see a substantial or a systematic reduction there.
Are you expecting any significantly higher costs on visas? I mean, I know it's a very...
No.
Nothing significant. Nothing significant at this point in time.
How has client demand changed when it's not digital transformation now, but
show live from Las Vegas. We have with us Jeff Fieldhack. Jeff, thanks so much for joining us on the show.
It's a pleasure to be here. Thanks for having me.
Jeff, what an interesting way to kickstart 2023, given